Good morning, everyone, and welcome to the Daily Hunt for Multibaggers on this Tuesday, May 26th, 2026. Hope you had a fantastic long weekend.
Absolutely, Ethan. We're back in the saddle after analyzing yesterday's market commentary, and I tell you, it was a busy one. We saw a lot of activity across social media discussions, with quite a few different stocks flagging for deeper dives.
Yeah, a lot of buzz, especially around the AI and tech sectors, with some really optimistic long-term views mixed with a healthy dose of market caution. So we've got some interesting debates ahead.
Let's kick things off with Antero Resources, AR.
Well, this one's showing some real fundamental strength. Despite a previous stay-away rating, recent news indicates an improving balance sheet and strong free cash flow. We're seeing robust revenue growth at over 34% and a very attractive PEG ratio of 0.66, suggesting it might be undervalued for its growth potential. Plus, insiders have been net buyers, which is always a good sign for future development.
I hear you, Ethan. Those are definitely green flags, but we can't ignore that debt-to-equity ratio of 57.771. That is exceptionally high, and while the news points to improvement, we need to see tangible shifts in that KPI. This past history of stay-away ratings also demands careful consideration.
Fair point, Brooke, but with the natural gas rally and improving financials, I think the narrative is shifting. Our AI-generated insights indicate an upgrade.
Given the mixed signals, especially that debt, I'd classify this as a cautious buy.
Next up, BlackBerry, BB. User sentiment is through the roof here. People are calling it the shovel to this AI gold rush with ambitious price targets. The stock has soared near its 52-week high, and insider buying has been substantial at over 21% net purchased shares in the last 6 months. It really feels like a company on the cusp of a turnaround with its QNX platform.
Ethan, the community optimism is palpable, I'll give you that. But from a KPI perspective, we have to pump the brakes. A price-to-earnings ratio of almost 88 is incredibly high, especially for a company with modest revenue growth of just 0.101. And that debt-to-equity ratio of 30.134 means significant financial leverage. While the AI narrative is compelling, the current valuation and debt profile present substantial risk for new investors. It's never been rated on our show before, so this is our first take.
I see the numbers, Brooke, but the excitement around its AI potential is hard to ignore.
It is, but the risk outweighs the reward for now. Our analysis suggests a stay away. Let's discuss Meta Platforms, META.
Meta continues to impress with fundamental strength. We're talking about 33% revenue growth and an incredible 32% net profit margin. Plus, its PEG ratio is a healthy 0.88, indicating it could still be undervalued relative to its growth. There's so much innovation happening in AI glasses and AR/VR, expanding their platform to developers. We've rated Meta a buy many times recently, and the momentum continues.
The numbers are strong, no doubt, Ethan. However, we've got an upcoming shareholder meeting where Zuckerberg will be grilled about massive spending on AI in the metaverse. There are also ongoing lawsuits concerning their AI ad model and some regulatory scrutiny. These are future uncertainties that could impact those impressive margins, While insider selling is minor, it's there.
True, but Meta has a track record of navigating these challenges while delivering growth. I see it maintaining its positive trajectory.
I agree the foundational strength is there. We will classify Meta as a buy.
Moving on to Microsoft, MSFT. Historically a consistent performer, and many see dips as buying opportunities. With a 39% net profit margin and 18% revenue growth, plus big investors like Bill Ackman making massive bets, it's hard not to be optimistic about this tech giant's continued dominance, especially in cloud and AI. Its last rating was a buy.
While those KPIs are outstanding, Ethan, the social media discussion we analyzed paints a different picture. There's a strong sentiment that the AI boom, including MSFT's role, is an unsustainable circular financing economy headed for a crash. Users are even pointing to MSFT cutting back on Anthropic token spending due to high costs, suggesting cracks are starting to show. This collective market skepticism about AI's profitability for MSFT is a huge risk factor.
I understand the concerns about a broader bubble, but MSFT's core business is incredibly robust. It's not just pure play AI.
But the perceived risk tied to their AI investments is too significant to ignore for new positions right now. This is a downgrade from its previous buy rating. We recommend stay away. Up next, SanDisk, SNDK.
Well, the discussion is mostly around a potential stock split, which usually happens when a stock is performing well. It's been labeled a great momentum stock, and it could benefit from this supercharged AI memory boom. It had a stay away rating recently, but I see potential for an upgrade here if the AI momentum continues. Ethan, a stock split is a technical event, not a fundamental improvement. What I see are some red flags in the KPIs. A price-to-earnings ratio over 50 is extremely high for only 2.5% revenue growth. And get this, a net profit margin of just 0.34%? That's incredibly thin. Plus, the debt-to-equity ratio of 1.50 is a concern. The news mentions an AI memory boom, but these current numbers don't show strong profitability. It was a stay away previously, and these metrics reinforce that.
That profit margin is definitely a tight squeeze.
It makes it too risky for a new position. We maintain our stay-away classification for SNDK.
Now let's talk about AST SpaceMobile, ASTS. The community sentiment is absolutely electric here. They're comparing it to SpaceX, highlighting defense capabilities, massive partnerships, and a global utility build-out. Users are calling it a game changer, ignoring traditional metrics because it's building a future network. They believe it's going to 10x from here. Last time we checked, it was a stay away, but the community optimism is huge.
Ethan, that optimism is certainly high, but we have to look at the hard facts. Our KPIs show negative earnings per share of negative 1.8, zero net profit margin, and a debt-to-equity ratio of over 112. This company is burning cash and heavily leveraged. And the most concerning part? Insiders have been net sellers of almost 18% of their shares over the last 6 months. That's a significant red flag from those closest to the company.
But the future potential is enormous, Brooke. They're building something truly transformative.
The financial reality coupled with insider selling suggests extreme caution. For the average investor, this remains a stay away. Let's turn our attention to Micron Technology, MUR.
Micron is showing phenomenal revenue growth, almost 200%, and an extremely low PEG ratio of 0.26. That suggests it's significantly undervalued relative to its earnings growth. The sentiment is strongly bullish, with users talking about it reaching $1,000 to $1,200 a share this year. It's been called a top stock for the long term and a great momentum stock, especially with the AI rally. Our last rating was a stay away, but these numbers are screaming upgrade.
The revenue growth and PEG are compelling, Ethan. I won't argue that. But we're seeing a very high debt-to-equity ratio of nearly 15, and more importantly, insiders have been net sellers of over 6% of their shares in the last 6 months. That insider selling is a strong signal that can't be ignored, despite the overall market excitement.
It's a tricky one, but the growth potential is just too significant to ignore entirely.
Agreed, but the risks are there. Considering the insider selling, we're upgrading this to a cautious buy.
Finally, NVIDIA NVDA. This company continues to be an absolute powerhouse. 85% revenue growth, a 62% net profit margin, and a PEG ratio of 0.66. It truly shows its potential is not fully priced in. Insiders have been net buyers of over 58 million shares. Despite some market-wide bearish sentiment about an AI bubble, NVIDIA consistently delivers and dominates its sector. Its rating was a buy recently, and I see no reason for that to change.
Ethan, those are indeed incredible numbers, and the insider buying is a strong positive. However, we're seeing persistent community discussion about the overall AI market being a speculative bubble, with some suggesting NVIDIA's high PE of 33 could indicate overvaluation. Its beta is also very high at 2.244, meaning it's highly volatile. While NVIDIA's financials are exceptional, the broader market sentiment of caution needs to be acknowledged.
It's a market leader driving the innovation, Brooke. The numbers speak for themselves, and it's consistently proven the bears wrong.
The fundamentals are too strong to deny for NVIDIA. We will classify NVDA as a buy.
All right, Brooke, let's quickly round up today's picks for our listeners. Investigate as buy, Meta Platforms Inc., NVIDIA Corporation NVDA. Investigate as cautious buy, Antero Resources Corporation AR, Micron Technology Inc. MU. Investigate as speculative gamble, AST SpaceMobile Inc. ASTS.
And that wraps up another episode of the Daily Hunt for Multibaggers.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for tuning in, everyone. We'll catch you next time on The Daily Hunt.